Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'm excited to share today's stories with you. We're starting off with a fascinating topic that's been making waves in the financial sector. Recent reports have highlighted the growing concern over retail investors taking excessive risks in the market, with some experts warning that it's a recipe for disaster. According to a survey, an alarming number of retail investors are engaging in risky behavior, such as trading on margin and investing in volatile stocks. On one hand, it's understandable that investors want to maximize their returns, especially in a low-interest rate environment. However, this kind of behavior can be detrimental to one's financial health if not managed properly. As we've seen time and time again, the market can be unpredictable, and even the most experienced investors can fall victim to its whims. On the other hand, some experts argue that retail investors are becoming more sophisticated and educated about the markets, which could lead to better investment decisions. With the rise of financial literacy and online trading platforms, it's never been easier for individuals to take control of their investments and make informed decisions. In related news, market analysts Tushar, Bohra, and Parag Thakkar shared their insights on the current state of the market, highlighting earnings momentum, banks, and discretionary consumption as key drivers of market upside. According to Bohra, India remains a stock picker's market, with only select pockets outperforming in the last year. He emphasized the importance of domestic cyclicals, domestic consumption, and strategic sector bets in driving market optimism. Meanwhile, Parag Thakkar noted that the RBI has taken systematic steps to improve liquidity in the economy, which should lead to increased risk-taking by banks and a pickup in lending activity. This could be a positive sign for the banking sector, which has been under pressure in recent times. As we navigate these complex issues, it's essential to remember that investing always involves some level of risk. While it's crucial to be aware of the potential pitfalls, it's also important to stay informed and adapt to changing market conditions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of retirement planning, where the stakes are high and the decisions can be daunting. Today, we're exploring a crucial aspect of securing your financial future, maximizing your IRA contributions, and making informed investment choices. As we've discussed earlier in the show, creating a robust retirement strategy involves multiple components, including understanding the different types of IRAs available, such as traditional and Roth IRAs, and how they can impact your tax situation both now and in retirement. It's also essential to consider the various investment options within these accounts, from stocks and bonds to real estate and precious metals like gold. Investing in a gold IRA, for instance, can provide a hedge against inflation and market volatility, offering a potentially stable store of value. Companies like Goldco specialize in helping individuals set up and manage gold IRAs, making it easier to diversify your retirement portfolio with physical precious metals. On the other hand, real estate investing through platforms such as Arrived and First National Realty Partners can offer another avenue for growth, providing access to residential and commercial properties without the direct responsibilities of being a landlord. These investments can generate rental income and potentially appreciate in value over time, contributing to a more diversified retirement fund. It's crucial, however, to approach these decisions with a clear understanding of your financial goals, risk tolerance, and the current market conditions. Whether you're nearing retirement or just starting to plan, seeking advice from a financial advisor can help tailor a strategy that fits your unique situation, ensuring you're on the right path towards securing your financial future. As we navigate the complex landscape of retirement planning, it's also important to stay informed about broader economic trends and their potential impact on your savings. with predictions of a possible recession and warnings of a greater depression from experts like Robert Kiyosaki. Having a substantial stash of savings and a well-diversified portfolio can be your best defense against financial uncertainty. In conclusion, retirement planning is a multifaceted challenge that requires careful consideration of various factors, including IRA contributions, investment choices, and overall economic conditions. By staying informed, diversifying your investments, and seeking professional advice when needed, you can work towards building a more secure financial future. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're wrapping up today's show with a look at some interesting developments in the tech space. Our first story takes us to Meta Platforms, or Meta, which has been making waves with its artificial intelligence capabilities. As we reported earlier, Jim Cramer was bullish on the stock back in January, citing its AI-driven ad business as a major driver of growth. And it seems he was right on the money, with the stock gaining about 30% so far this year. But what's really driving this growth? According to reports, Meta is leveraging its massive user base and data edge to develop targeted ad packages that are paying off big time. In fact, digital advertising accounted for a whopping 98% of the company's total revenue last year. And with daily active users numbering around 348 billion, it's no wonder Meta is seeing returns on its AI investments. However, as we always say on this show, past performance is not necessarily indicative of future results. Meta is expected to spend a staggering $60 to $65 billion on capital expenditures in 2025, mostly to expand its AI infrastructure. While this could pay off in the long run, it's unclear whether the company can deliver short-term results that will impress shareholders. Meanwhile, another story caught our eye. CoreWeave, a cloud computing company, has just inked a major deal with Meta Platforms worth a reported $1 billion. The partnership aims to provide AI-powered cloud infrastructure for Meta's various platforms, including Facebook and Instagram. This is a significant development, as it highlights the growing demand for AI-driven cloud solutions. Now, we know some of our listeners might be thinking, Lewis, this all sounds very promising, but what about the risks? And that's a fair question. As we always say on this show, investing in tech stocks can be a wild ride, with plenty of ups and downs along the way. So it's essential to approach these investments with caution and do your due diligence. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.